Good morning, good afternoon, and good evening, folks, depending on your geolocations, wherever you guys are based. From myself, it is good afternoon, and it is 1300 BST, British Standard Time. It is great to have you guys with us as always. And in our today's series, in the series of web masterclass today, we will be focusing on indices. Remember, yesterday we had another webinar where we discussed about stocks, which was very much because we had to cover our last week's topic. So we did stocks, and today we are going to be discussing about indices. So, and in a slightly bit more bonus for today's session is going to be that we will not only be looking at the US indices today. I will also try to bring some of the European indices as well at the same time. So perhaps, that would kind of give us a little bit more flavor into things, how things will process from there onwards. Now, before we proceed any further, if you guys can hear me very well and if you can see my screen as well, please do give me a sound check and a screen check by saying yes or no. If you can't hear me, then do let me know as well. Well, welcome back, Amutha, Andreas, Leonard. Great to have you guys back and the rest of the people in the room for sure. It's good to see the familiar names all the time. And coming over here, Guru Same, if I'm pronouncing your surname correctly. Good to see you here as well. Now, before we begin, as always, it is important for me to go through this particular slide of disclaimer. Anything which will be discussed cannot be perceived as an advice. If you are looking for one, please do consider consulting with your own financial advisors. Just a bit of housekeeping in relation to contact details. Our handle for Twitter is AvaTrade, and it's the same for YouTube as well. On the daily basis, we put two different videos, and that is daily fundamental video and daily technical analysis videos as well. So do keep an eye on our YouTube channel in order to learn about that. Now, in terms of AvaTrade's unique technology, this may be quite useful for you guys. AvaProtect is a revolutionary one-click risk management tool available on the AvaTrade web trader and the AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, AvaTrade will reimburse the loss directly into your trading account. The only cost is the AvaProtect fee itself. Now, as for the study questions and the agenda for today, the following are the questions, and I kind of wanted to go back to our webinar that we did yesterday as well. Wanted to ask you guys a few questions, especially for those people who are attending our webinar, who actually attended our webinar yesterday. That how did they go? Did they get actually did you guys take any of those trades? Because obviously market kind of moved in the direction the way that we kind of predicted as of yesterday. So we will discuss all of that with respect to the price action later on. But for people who are returning to these series of webinars and for the right reason for sure, because the thing about learning is that there is no such thing where you can call yourself that now I'm an expert, because this particular environment is changing all the time, and this is where we need to know where the market is really going to be moving. Now, right now, in terms of fundamentals, we have a big event taking place today, which will be at 7 p.m. British Standard Time, and it will be about the Federal Reserve's meeting minutes. So they are going to bring enormous amount of volatility for our Forex, for commodities, for equities. So these three markets where you wanted to really keep an eye on. But the first study question I wanted to put out to everyone in the room Why do you want to trade indices? Can anyone answer that study question for me, please? What is the relation there? Why is it is quite good for us to trade indices? Any answer? If you think that it is good for to trade indices in comparison to stocks, then why is that? What is the benefit of that, of really happening? Like, there you go, Amutha, it has said because it's a group of stocks. Excellent, Amutha, you are absolutely spot on with that, because number one is that you are trading group of stocks when you trade indices, because when we talk about the US Dow Jones 30, you are trading all the 30 stocks. And then Amutha also mentioned diversification, and that means that we have less risk. We don't have an exposure to one particular stock. In fact, we have sort of a wider exposure to a number of stocks, so that kind of reduces our risk. Shane, please check your audio from yourself. Okay, so you said it's already sorted. Everyone can hear me perfectly. Just wanted to make sure, because Shane had some issues, but seems to be sorted. So if anyone has any issues, yeah, okay, great. So everyone is saying that it is all good. So is everyone clear about the first study question? Why do you want to trade indices? So again, number of reasons. That is because this is a group of stocks. So if you have $1,000 in your pocket, then you'll only be able to buy very limited stock, and especially when it comes to Amazon, you may not be able to do anything there at all. But if with that $1,000, or with a $5,000, you can trade all the Dow Jones Industrial stocks or all the S&P 500 stocks, because S&P 500 represents all the top 500 companies over in the United States. As for Nasdaq, similarly, you'll have an exposure to all the top 100 stocks for the Nasdaq. So it is pretty good in terms of volatility, because from day trading perspective, you do have a big range as compared to particular stocks where they'll be just moving in a very small range. With respect to the Dow Jones Industrial Average, we know that it can move on a volatile day easily between 500 to 1,000 points, and on extreme days it can go up to 1,500 points or even more as well. So that 3 to 4% movement in S&P 500 is also quite substantial, and the same goes for Nasdaq. So from a day trading perspective, you really have that big range to trade, as opposed to stocks where they'd be just only a few dollars here and there, and then that's it. You are done for that particular day. Now, the inverse of indices, we will look at the volatility index, the VIX index. It moves in the opposite direction to the S&P 500 index. So when the S&P 500 index moves to the upside, the volatility index moves to the downside, because at the time traders are taking the risk by trading the S&P 500 index, and the VIX index is obviously risk off asset. When everyone is taking a risk on, the risk off asset is less popular, hence the prices kind of falls for the volatility index. But obviously when it comes to an important level of support, when it becomes extremely cheap, that is the point of entry for potential traders to start buying some hedge on their positions while the market may continue to move higher. Because when the market will drop, what will eventually happen under that particular circumstance would be that, let's say that the market begins to fall, then what you will have is that you will have your volatility index would be rising from that particular point. So for instance, if I can just draw that on the chart, if this is your S&P 500 index, it's moving to the upside, and this is your VIX index, it is moving to the downside. When it gets to an important level of support, so that support level could be over here, when it reaches over here, what traders do is that they start to buy the index at that volatility index, the VIX index, at that point, because they think that at that time the volatility or the insurance is too cheap, while this may continue to move higher, and at the same time it will be getting very close to its resistance level, and that means that this can move to the downside. So when this moves to the downside, you will have both the volatility index towards its lows and then you would be able to make pretty decent gains on the back of that. So does that sort of make sense to you guys? Because this is your S&P 500 index over here, and over here we are talking about your volatility index. So that's why it's called the inverse of the indices. If you guys are still unclear about that, feel free about that, and then we can talk a little bit more on that. And then we have the fund flows. This is slightly bit more complicated, so we will discuss that if we have the time remaining. Otherwise, we will talk more about defining levels and defining strategies from the MT4 price chart, and then we'll be maybe kind of discussing them in more sort of a detail. So now I think it is time for me to bring out the MT4 platform. People are saying that so Andreas, you're saying that you only see the agenda sheet. I mean, that is where we are currently. So, I mean, that's where we've been talking about the all that stuff. So let me now bring out the MT4 platform over here, and so that you can kind of see the price action from here. Now we'll be talking about the price action from here onwards. So now, first of all, as you guys remember, yesterday we talked about the S&P 500 index. We talked about the price sort of forming, consolidation pattern, and we talked about the possibility of prices moving to the downside. And then guess what happened? As of yesterday, price did move to the downside. Now, of course, the big question for investors and traders is, where should they buy the index, given the fact that the prices are sort of moving to the downside? Where is that buy zone? So that is exactly what we are going to focus in this particular webinar, and also where are those important price levels. So let me kind of zoom out a little bit out of this one. So, and first of all, what we need to pay attention to is the three important moving averages with respect to the Dow Jones Industrial Average, because this is Dow Jones Industrial Average, represents your 30 top stocks in America. And and then we have three different moving averages. This is your 200-day simple moving average, followed by that is your 100, and finally your 50-day simple moving average. The general concept in the market is, when the price is near its 200-day simple moving average, we are very much likely to see massive buy orders coming in. So let's say if the price continues to fall and it doesn't stop over here, and it doesn't stop over here as well, and it continues its fall, then over here we are likely to see big buy orders coming in that could really push the prices to the upside. Why? Because at that time the price is really oversold. Traders would consider that as a buy opportunity, but at the same time traders do consider a buy opportunity at every single price level as well, like the 50-day simple moving average. So meaning, when the price may continue to move to the downside and it may visit this particular price area or near this 50-day simple moving average, we could eventually see a price topping or moving to the upside. But currently, what we really also have is that we have our 200, 100 and 50-day simple moving averages trading very close to each other. For instance, over here we have your 100-day simple moving average, and over here you have your 200-day simple moving average. So what we really sort of have to do is we have to encompass both of them over here. So this entire 34,340 to 34,737 becomes your support area. Now, you may be asking me this particular question, that why are we looking at such a big support area? How can we really deal with such a big support area? Well, the answer to that question really is that if you are going to buy 10 contracts, now because the support zone is quite big, as the price comes in, you may want to buy 2 contracts over here, 2 contracts over here, 2 contracts over here, 2 contracts over here, and then the remaining position just right over here. And if the price falls further from here, then you have your stop loss just right at this particular price level, and you take this particular loss from this point to this point, and then you get out. However, if you are right, and if the price changes its direction to the upside, then remember, our initial risk is only this much, from here to here. That's our initial risk, but our reward, our target is really up to here. So what we really be talking about, risking this much and then gaining more than 2.5 times. So it would make sense. So rather than buying it right over here, right, but you can buy slowly, 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 or the other strategy at the same time in terms of a position sizing could be that rather than buying the 10 contracts, let's say that usually you buy 10 points or 10 contracts, then because the support zone is quite big, you would buy only 5. You will reduce that position in half. Why? Because usually if your support zone is this much, if this was your original support zone, just this much, your, but now it is double because now we have also included this particular area. Then what we need to do is we need to cut that position by 2 or literally in half. Hence we'll be only tracking that 2. Similarly, if you're taking only 1 unit, one contract, then you divide that by 2, and then we'll be taking only 0.5 contract because the support zone is quite big over here. Any questions on that? Because it's a very, very important concept, and I want you guys to be very, very clear on that position aspect of how to position size according to a bigger support zone or according to a smaller support zone. Okay, people saying that they are clear about that. If you remember, there is no right or wrong question. You can always go back in the recording and then learn a little bit more on that. But again, to summarize, if you are going to take one contract, or if you're going to take one buy order, one contract, then you will not, because the support zone is big, you will reduce your position size to 0.5. Then under that circumstances, what will happen is your stop loss would very much remain the same. Your losing situation would remain the same. Buying at, so Henry is asking what of buying at 32,874. 32,000, so 32,000, you are talking about, my friend, 32,000 even lower. So you were talking about in around over this particular area. Yes, you could certainly, I mean, like this, all of this is a very, very interesting support area as well, because if the price doesn't stop over here, then the next move is certainly going to be here, which is very much in line with what we are discussing or what you have said to me, Henry, as well. But this requires patience. Now, obviously, you need to wait for the market to drop to this particular point, and it probably will take quite a long time. So once again, this is our risk over here, this much, and our reward is this much. So this is our risk, this is our reward. And please always feel free to ask me any questions, because there's no such thing called stupid question or wrong question, because every question is a right question, because it helps you to have some clarification in relation to your trading. Now, overall, so we've decided that this is our support area number 1, this is our support area number 2, and afterwards what we will be very much looking at is if the price continues to fall, then we can look at this particular area. Now, because this is support, I like to keep my support zones in green, so I'm going to change the color to green. So this will be the area. In terms of your resistance, the at least area that we're looking at is 35,633, and then from there onwards, the momentum likely to continue to the upside. But if we look at the RSI, it is still maintaining its upward trend to a larger extent. What do I mean by that? So if I draw this line, we can see that the RSI is very much maintaining its trend over here, right? But if the RSI begins to break below this upward trend line, and then we see a move to the downside, really, then it means that the prices are going to be moving into here, or possibility of prices moving into the second area. And what we would really like is the price come into this area, which is below 30, because below 30 or near 30 is oversold. If the RSI is over here and the price is over here, bang, the possibility is going to be that the prices are very much likely to move to the upside. Now, I know I have taken a long time on the Dow Jones Industrial Average to discuss this one, but in the following charts, now we're going to move slightly bit more at a faster pace. But if you do have any questions in relation to this one, please feel free to ask me, and I'll be more than happy to answer them. Now, Let's go to the S&P 500 index. Again, the concept is very, very similar. The prices are still continuing to move to the upside. The index is in a strong upward trend, as you can see it from here, from this particular line. The prices are very much respecting this upward trend line. They're continuing to trade above this particular trend line. If I can make this line a little bit more heavier for you guys to see. So that is the trend line that I'm really talking about. So the prices are very much trading above this line. In fact, what we also have at the same time is sort of this upward channel which is forming for the prices, and sort of every time the price kind of goes over here, then it sort of reverses to that. Now we are trading in between the channel, so the chances are that we may actually the price may actually reverse its direction, and then we may see the prices moving back towards this area of 50-day simple moving average, or we could see the price coming and retesting this line over here, which was very much formed over here from this particular price level. So this is what we would be very much focusing on in terms of the S&P 500 index. Now, of course, the next question is, where is our important support area? Now, again, we are going to try to encompass where the 50-day simple moving average is very much trading. And from there onwards, we're going to take our support areas. So the first immediate support areas for those traders who who can't really wait for too long is going to be near the 50-day simple moving average. And then afterwards, the area which is more in line for those traders who like to try a bit more patience is going to be coming from where the 200-day simple day moving average is trading. So just right around this particular area. So this would be a much better area of choice. And then we do have something in between that as well, which is your 200-day simple moving average. And for that, we would be very much focused on the low of this particular candle and just over here. So we have three different support areas for you guys to really focus on. So number one area is right over here. Number two area is right over here. Number three area is right over here. Now, in terms of our risk to reward ratio, if we are looking at it from the perspective of risk to reward ratio, we are gonna expect the market to continue to move higher. So really the next sort of a price level in terms of a price target is very, very much likely to be near 45,000 sort of a 4,500 sort of a price level. So that is what we would be very much expecting. Now, in terms of a risk to reward ratio, what is that going to be look like? Now, of course, if we are looking at the area number one, then our risk under that is going to be only this one, right? From this line to this line. So that is our risk. And our reward, if we take the trade and the price begins to move to the upside, really, then our reward is going to be really around this particular price level, nothing less than that. And that means our reward becomes this big higher. This is our reward. So our risk is very small and our reward is very, very high from this particular price level. Again, at this particular price level, this becomes our risk. So anywhere in between that, if you even enter over here, put your stop losses below this one. Over here, our risk becomes this much. So again, if you enter over here, then you put your stop losses just below this line. So you can enter anywhere between from here to all the way to this line. So anywhere between here to here, but put your stop losses just below this particular price level, these particular price levels, just below these particular price levels. In case if you are wrong, then you do have some sort of a thing to look at. Now, so Henry is asking me to look at gold. Henry, this is mainly about indices, my friend. So I will try to cover gold if we still have the time remaining for sure. Now, with respect to the US Tech 100, what is happening over here is that the prices are very much forming a sideways consolidation pattern, and then this is the sideways consolidation pattern that we are very much referring to. So the price isn't really going anywhere, but just moving to the sideways direction. Now, what we kind of wanted to wait in terms of a price action over here is we want the price to either break to the upside from here, so either begin to move to the upside or either go to the downside, because otherwise, It is sell it over here when the price reaches the high of this candle, and then buy it over here when the price reaches near this particular line. Now, for our support zone, for our immediate support zone under the current circumstances is going to be where our 50-day simple moving average is trading. So again, that is very much in line with that consolidation pattern over here. Now, if the price it breaks that particular price level, then our next support zone is very much going to be in around this consolidation area, and then that is where the 100-day simple moving average is trading at. And after that, if the price continues to even move lower and it doesn't respect that particular price level, then the next area of support for us is going to be very much where the 100-day simple moving average is trading. So I'm really looking at this particular candle over here. So let me draw them in terms of the scenarios. If price doesn't stop in this area, which is our scenario number 1, then we are likely to move into the scenario number 2, and then scenario number 3. Now, in terms of a risk to reward ratio, this remains your risk between this particular line to this, and your reward is going to be from this line to that line. So that means all of that is your reward, and anything above that also remains your reward as well. Same becomes over here. This is your reward and risk, and in terms of your reward, you'll be very much looking at the all-time high, and then your reward becomes even more larger over here. If this is your risk over here, your reward is again going to become even more larger, and we would be looking at this particular price level. Sorry, the chart has become a little bit more messy. Let me get rid of all those price levels and make it again for you. So number 1 support area, number 2 support area, number 3 support areas. Of course, you could buy it over here as well, because this is equally a nice sort of a price level where price may actually violate, and then it may just come over here and then begins to bounce back over here. But for traders who like to have a more certainty, like to have a more odds on their side, then they may want to do this one. Is the criteria same for the US 30 and DAX? Yes, Romano, that's absolutely correct as well. So we're going to quickly cover that as well now. So we're going to cover the DAX index at the same time, because we do have some minutes, some time remaining. So let me bring out the DAX index over here. So with respect to the DAX index, what we really see is we see that the prices are, let me get rid of this. Where was this? Sorry. Not sure why this line is not moving, but I mean, it should move. Okay, it should move. There we go. Delete. Just trying to get this line to delete. Okay. Now, as you can see, the first area for DAX is going to be very similar to what happened with the Dow Jones, because we have a 50 and 100 trading very, very close to each other. So we're going to have our support zone a little bit bigger. So this one is going to be our support zone. For our second support zone, it's going to be slightly bit in around that particular price level where the 100-day simple moving average is trading. You can actually increase a little bit over here just to include the low of this particular candle. So with respect to DAX, what we do have is we have a slightly bigger support zone. So that means that you cannot take the full position, 10 position, because that will increase your stop, your risk. So what we want to do over here is we wanted to, if you normally take 10 contracts, you may want to consider 5 contracts again, because the support zones are big. And the same goes over here. If you take 5 over, and then you may want to consider that as, if you normally take 10, then you may want to consider as 5, just because the risk over here, the support zone is quite big, sorry. So if you enter it over here, you know, all of that is quite a big stop. for you to really digest, as opposed to if I had the support zone drawn just like that, then our risk was only going to be this much, only this much. But now our risk is this much, starting from this line to that line. So we need to reduce our position size accordingly. If the support zone is big, then we don't take the full position, we just reduce the position size. Does that make sense to you guys in relation to the position size? What we're really referring to. If you guys want, we can do a full seminar, or sorry, webinar, just discussing the position sizes. People are saying that, yeah, it makes sense. All right, so someone did handy ask me to look at gold, so I'm going to quickly have a look at gold price now before we call it a day. Okay, in terms of a gold prices, it's very much the price is getting challenged near the 50-day simple moving average. So I'm gonna actually delete this particular line, because for me, the next important price level is really going to be where the prices are trading right now, and that is this going to be 1829. So if it breaks above that 50-day simple moving average, we are more likely to continue to move to the upside. All right, folks, that's all for today. Thank you so much for your time as always, and I will see you guys next time, same place, same time.